Okay, recording this video, it's Friday 25th of October 2013. It's quite a few hours before the open on Friday. I hope you're having a great week's trading. Thought I'd record a video on the British pound, and is the British pound going to break to multi-year highs? Now, I've been pretty bullish on the pound and the euro over the last couple of months, and got a great little email, well, rather long email in fact, from Steve in Oxford in the UK asking about that. First of all, he's got a question and a minor quibble. He's kind of got a contrary view on what the pound might do, but let's deal with the question first of all. I shan't read all of this to you, but what it boils down to is a question about this at BP in brackets D, and he's asking what are the respective merits of using daily data as opposed to full overnight data when doing long-term analysis. Now, there's a little bit of confusion here. Let me try and clear this up. First of all, this is a chart of the E-mini on TradeStation. Two different charts. One is at ES and one is at ES.D. Now, the at symbol in TradeStation means continuous contract. That means all of the futures contracts have been combined or concatenated together to give you a long time period here. You know, remember, futures contracts are for 1 quarter, so if you want to get a long-term history, you have to join them all together. So that's what the continuous contract means. This chart is just at ES, and that means it's got the day and the night session. The .D means, remember this is .D, means that this is the day session only. And you can see on the day session only there's no nighttime data in this chart, and so you'll see a lot more gaps, gapping between the close one day and the open of the next day. Whereas on a continuous chart using day and night, you get far fewer gaps. Essentially the only time where we really don't have any trade going on is between the close on Friday and reopening kind of on the Sunday evening on the E-mini. We get there's tiny gaps, while after the day session when there's a little bit of a pause in trading, but essentially those are the only gaps that you will see. So there we go, that's what a day session means and a day and night chart looks like. Now, the reason I use the day and the night session is because I'm using tip bar charts, and since there's very little activity compared to the day session during the night session tends to be rather kind of slow. On a tick bar chart, all of that time can be compressed into a few number of bars, and we get a nice kind of looking chart. Alternatively though, if you're using a time-based chart, something like a 5-minute or a 15-minute whatever chart, all of that dead time during the overnight session when nothing really is going on, it just looks really odd in a chart. So that's why people kind of tend to have day charts, day session only charts, because most people are just using 5 or 10-minute, 15-minute charts, something like that. Because we're using, or if you're kind of a follower of Emini-Watch and I've got you under tick bar charts, you'll be far more used to seeing the night session, because on a tip bar chart it looks kind of good, and you can understand the trade between the day and the night session. Okay, so that's talking about the E-mini. Now, and most futures contract. The Forex contract is slightly different, and I brought up 4 different charts here of different ways of looking at Forex. Now, note, this is at BP, so this is the British pound, but the D is in brackets. So the D in brackets in TradeStation means that the data is delayed. So this isn't day session only, this is delayed data. Now, delayed data in TradeStation, I think it's only delayed 15 minutes, but because I don't trade Forex, I don't need the real-time data. And I'm already spending almost $100 on kind of data feeds a month. I don't want to be adding to that by getting real-time data that I'm not actually using. So that D in brackets means delayed data. But then there are some little quirks when it comes to Forex data on your trading platforms, and I think most of them are similar, so let me just explain what's going on here. So that BP is just the continuous contract delayed data, and then you've got a .P and a .C, both delayed data as well. And you can see the differences here. .P means pit traded data, and that's more akin to kind of the day session data. The .C means bind, I believe. So that's combined with the electronic and the pit traded. And for all intents and purposes, this .C is very similar to just the at BP. It's only when you go back using monthly charts that there becomes a difference between those two. But this is pit traded, and so this is more like the day session type data, and it's not kind of electronic. And you can see it kind of gaps around far more and is less kind of pretty or smooth. I wouldn't suggest you use that. I would just use the at BP continuous contract, day and night session. And because the Forex contracts trade pretty much 24/5, so there is less of a distinction between the day and the night session, because they're essentially kind of traded round the clock. And then to round things off, there is a difference between this at BP, which is the futures contract traded on Globex, and the cash markets. And the cash markets is represented with, again on TradeStation, GBP USD, which is Great Britain pound, US dollar. So this is the cash market, and this is the futures contract. And again, the reason why we're using the futures contract is we get volume data here. So there we go. That's the answer, hopefully, to the first question that Steve had here about this D in brackets. That means delayed and not day session only data. He also has a little bit of a quibble about kind of different plots for beta sine wave, and I think that might be a data issue that he is having. I've refreshed my data here on the British pound, and I still believe there's a weekly break, so we'll refer to that in the next kind of charts kind of going forward. Now, just before we get to his question, this is a useful setup for the futures, for the Forex charts that I kind of use to get an overview of what is happening every day. And I'll just suggest this to you as a way of kind of setting this up. The 6 major currencies that are worth kind of tracking. We got the dollar index, DX here, and the Japanese yen, JY. Then we've got the euro, EC, and the British pound, BP. And then we've got the Aussie dollar, AD, and the CD for Canadian dollar. Now, the reason I put them in that kind of setup is on the right hand side here, what we have is the Aussie dollar, Canadian dollar. These are commodity based currencies, so they will move with the commodities complex. Aussie dollar is obviously focused more on the Asian markets. The Australian economy is an export economy, focused primarily on China, Japan, and the Asian markets. The Canadian economy is again export based, resource based, but more focused on the US markets. But they're closely aligned to the commodity kind of complex. Now, in the middle here, we've got the euro and the pound. The European economies and the British economy are far more service-based. So that's why they're kind of grouped together. The pound, the UK economy is very similar to the US economy, and you will find that the pound moves in a very tight band or tight range with the US dollar for long periods of time. Yes, it gets kind of big breakouts at certain periods of time, but you can go for a long period of time looking for a breakout move in the British pound, and it just won't happen because the economies are effectively so closely aligned. The European market's far more interesting in terms of their dynamics and growth, but that's why I've got these two together, because they're service-based economies and they kind of move together. Then on the left-hand side, dollar index and Japanese yen. These are carry trades, carry trade currencies. So traditionally we've had the lowest interest rates in the US and in Japan, and so investors will borrow money in those markets and invest them in high growth opportunities around the world. So that's why I've got those kind of down there. Now, from time to time, as carry trade currencies, they will move together, but other times they won't. So for example, at the moment the yen is moving to a different beat, and it's based on Abenomics happening in Japan, and that's why as a carry trades they're not necessarily kind of moving together. And normally what you'd see is the dollar index versus these 4 currencies being risk on and risk off. So when we've got a risk on situation, we've got kind of these growth opportunity currencies tend to go up, and the dollar index kind of goes down. Risk off, we get the reverse. We get dollar index going up, bonds going up, and equities and risk kind of markets kind of going down. However, at the moment, what I find is quite interesting is we've got the euro and the pound going very well at the moment, and they're kind of strengthening and have been for months, whereas the Aussie dollar and the Canadian dollar have been weakening for the last 6 months. And I think what we could be seeing is a little bit of a breakdown in this kind of traditional risk on, risk off type thing, where there is a difference between these more kind of BRICS, kind of emerging economy type currencies, and these more kind of mature economy currencies. So that's going to be interesting kind of looking forward. Traditionally they've kind of moved very tightly together, but we could be seeing a breakdown in that. The Canadian dollar and the Aussie dollar will actually start to move differently than the pound and the euro. So look for that kind of going forward. Okay, now back to Steve's email. Part 2. talking about multi-year highs. So sterling, though strong since bottoming in the summer and quite possibly destined higher, is still on a weekly time frame stuck in a multi-year range. Support in the high 140s, resistance in the low to mid 160s. Indeed, as of this writing, is yet to clear its year-end 2012 high and could, until proven otherwise, be argued to be putting in a double top. Can it really be right to talk of a new uptrend on the weekly time frame until we get above this multi-year resistance? Now, this is the essence of breakout trading. And how do you pick good breakout trades, winning breakout trades? Because the essence of trading is when you get to a previous support or resistance level, the question is it going to bounce off that support or resistance level and go back into the channel, or is it going to break through it into a trend move? That's what the essence of trading is about, is getting that right. When to fade the breakout and when to follow the breakout. So let's look at a long-term chart. This is the continuous contract of the British pound going back to 79, and on a monthly chart here, just with better sine wave. And you can see there are periods when the pound has gone through really strong moves. Just out of kind of curiosity, this was the mid 70s to the early 80s, and this was when Thatcher came into power in the UK, and there was actually all of a sudden we'd been going through horrible 70s, miners' strikes, you kind of name it, in the UK. Thatcher kind of came in, and there was a renewed confidence in what might happen in the UK. And then the early 80s, this is when Reagan came into the US, and all of a sudden there was renewed confidence in what was going to go on in the US. Lower tax rates, more kind of corporate friendly type policies and so on, and the pound went down because the US dollar was strengthening so much. And then you can see we go through periods where there are large kind of ranges kind of going on here, yes, and occasionally we get these really kind of strong shifts kind of down. Again, ranging type moves, and then we go into a break move. Now this is coming into this kind of local high up to $2. I mean, I remember when the Brits would they couldn't believe their luck. The pound was worth 2 to 1 versus the US dollar, and they were going in their droves from London to New York to go shopping in Barney's, and they loved it. And then as soon as the financial crisis came along, whack. This was a rush. This was risk off, rush into the US dollar. The pound got whacked. Everybody was buying government bonds, US government bonds. The dollar kind of raced up. Now, ever since, we've been in a very strong, very wide kind of trading range. You can see better sine wave, support, resistance, bang, bang, bang. So, Steve's question is, he's saying we're in this range, the 140, 150 kind of at the lows down here, and the 160s, mid kind of 160s up here on the pound. Why should we break out of this congestion zone? Why should there be a break at this point? Why wouldn't we just bounce off like we have over the last 4 years? That's been the trade to take, is to say, no, at these highs, we're selling the thing and it'll just kind of go down. So that's it. That's the question. Are we going to break to multi-year highs or not? Now, I've got two responses to that. First of all, out of congestion you get trend breaks. So markets move between congestion and expansion. Congestion phases where they're kind of building up energy, and the people get wrong-footed, the breakout traders get wrong-footed, because all we do is we come back into the range and we just move like this. And then expansion. After we've gone through several of these cycles like that, the probability of a breakout trade becomes higher. The more of these kind of support resistance we put in, the greater chance that there will be a breakout, because everybody's taken trades in there, got a large amount of money kind of invested, and it doesn't take very much more to push us out of the congestion zone. And then once we're pushed out of that congestion zone, the people that are wrong-footed, that are the wrong side of that trade, have to cover. They have to do the reverse, and so they kind of add energy to the breakout move. So the more congestion we see, the more likely it'll be that we will get a trend break out of that. And it's just a question of figuring out, when is that good trend break going to happen? And that's when I say, not go to the mattresses, but go to the better indicators. Go to the better indicators, because they will show you which way the trade is going to break and whether it's going to be a good break, whether it has professional support. So let's go to the weekly chart of at BP. So again, this is continuous contract, just delayed data. That's what the D is suggesting here. And this is the weekly data. So now you can see that huge sell-off that we had from $2 down in 2008 down to $1.40 for the pound, and we've just been going through this consolidation ranges here with support resistance, minor breaks a couple of times, but then we're kind of setting up. Now, why is this going to break out and why is it going to keep going? So first of all, we've put in all of this bottoming activity. We've put in all of this selling energy. Look, we've got an exhaustion pattern back here in 2010 on the weekly chart, exhausting all of the sellers. We've come back again into that kind of the bottom of that congestion zone again. We exhausted the sellers. The last time in, we're now starting to see bullish divergence patterns kind of come in. So we've got bullish divergence at this point here, suggesting there is less selling going on. So there's less appetite to sell down. The sellers, all the sellers have sold effectively. That's what the point that we've reached at this point. The other thing to note is better sine wave. Better pro-am. Better pro-am blue professional bars coming in at these lows in 2010. Long-term holders, during this kind of capitulation type phase. I think 2010 we were. At some point there was a British downgrade. At some point, I think it might have been here that we got the actual downgrade of the UK economy by Moody's, I think it was, and that was again psychologically everybody said, well, the pound's going to fall through the floor, blah 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 blah. That's the huge volume that went on there that kind of flushed everybody out at this point. But we have blue professional bars at the lows, at the lows, at the lows, at the lows here. Now, they've kind of come in at the highs and taken profits, kind of forced this thing down. But here's the difference. With what the activity that we have at 160 at the moment, no blue professional bars. Last blue professional bars that we saw on the weekly chart was, I call this a bit of a U-turn. So we've got the professionals picking it up at the lows here, and then they're anxious to get on board. There's a final test down, a final push down to the lows of those blue professional bars. Went a little bit further than I'd have thought on that weekly kind of bar there. But what that did was flushed out the last of those sellers, weak selling, bullish divergence kind of comes in, and we crack all the way back up. So we're now above that kind of acquisition zone there. And they're not interested in letting go yet. They've not seen blue professional bars at these highs saying that we're taking profits. This is as far as it's going to go, to the top of this kind of range up here. And the blue professional bars as yet have not kind of come in. Now, we do have an exhaustion pattern here, but there's a difference, and this exhaustion pattern here is getting this move going. This is showing, as we head back up to the top of this channel, a lot of people have been wrong-footed, and that's a short covering rally. So as we head back up, they're anxious to either get on board or cover their short positions. It's different from the exhaustion pattern that we have here and here. This is happening on a left shoulder, on an extreme of price. This is happening while we're still in that congestion area, inside that kind of range. What's that is showing me is there's a lot of interest in getting on board and getting into that market. So, two reasons why I think we're going to break out to long-term to multi-year highs, break above this 165 type level, is we've spent a long time in congestion, and therefore we're likely at some point to get a successful breakout. And then the second reason is, let's get the direction correct, and we can see that we've had all the exhaustion patterns at the bottom of this channel. We've had the blue professional bars come in at the lows of this channel, and it's likely to break through these highs because we've not seen blue professional bars taking profits at the top of the channel as we've kind of seen previously. So we're above resistance on this weekly chart, not seeing the blue professional bars. This is showing the strength of the buying, and so I think this is going to go higher. So last thing to show you is just commitment of traders. Commitment of traders is always, I find it useful to look at just on these long-term charts, just to see again if there's kind of a commitment of traders reason why this kind of should be going up. Now, as everybody knows, with the government shutdown, we've had no commitment of traders numbers for like 3 or 4 weeks. So hopefully this weekend, I hope we get a flood of numbers. I hope they don't just do the last week and forget the rest, because that won't be very interesting at all. But anyway, you can see the commitment of traders. This is how I like to plot it below the chart, just so it kind of the swings in the commitment of traders mirror the swings in price, and you can see bullish divergence type patterns, bearish divergence, bullish divergence, and so on. I'd love to see us, what the data is today to show that that's kind of supporting this trend move up. We didn't get a bullish divergence on the weekly chart, but if you look at it on a monthly chart, we've been having bullish divergence patterns kind of down here. Now the last couple, didn't necessarily kind of go anywhere. nor did this one. This one did kind of rally quite a bit, but again, because of the exhaustion patterns being wound up in this range and having professional support at the moment, and professionals have not taken profits yet, that's why I'm suggesting that we're going to break out through those highs. And you know, it's a kind of contraindicator for me when I put out the video on the Aussie dollar getting whacked and go short the Aussie dollar, when I put out the video on the euro going up. Also not on the oil, interestingly enough, but I'm just thinking back, I got a lot of pushback from those videos saying that Aussie dollar was going to get destroyed, kind of wait for it and so on, particularly because, again, there are quite a few Australians who kind of follow the site, and they were very pro the Aussie dollar and so on. Funnily, when I get emails like this, kind of not arguing, as Steve says here, a minor quibble, and that's exactly what it is, just a difference of opinion whether we're going to break out to multi-year highs or not. And who knows the future? Either one of us could be right, and we might both be right, but in just different time frames. But when I get pushback like this, for me, I start to understand what the conventional wisdom might be out there in terms of what's going on with these charts, and so that, in a funny way, makes me feel a little bit more confident. In fact, in saying that this could well break out. And you look at it, I mean, it's this level up, kind of the mid-60s, is absolutely key. And if we kind of punch through there, who knows where this will go? It'll travel a bit, I'd suggest, because there's a lot of people who are thinking it will do otherwise, and they'll have to cover and get on board. So there we go. I don't know how long this video is wrong. Apologies, this is a bit long, but if you're interested in kind of the British pound or currencies or kind of breakout trades in general, I hope that was useful to you. So good luck with your trading.